I'm Chrissy Fontanilla of FAS Bookkeeping and Tax Services, and welcome to another presentation. This time, the topic is taking money out of an S corporation. So there are ways to take money out of an S corporation the right way. This includes wages, distribution, loan, and reimbursement of expenses. So first, let's talk about wages. A shareholder who worked for the business can be classified as an employee and can receive the same treatment as any other employee, like getting a paycheck, taxes withheld, payroll taxes paid, and then you get a W-2 at the end of the year. An important consideration when you're paying yourself wages as a shareholder is that you should be receiving a reasonable compensation. So, what is reasonable compensation? Why is paying shareholder reasonable compensation important? So first, let's define what is reasonable compensation. And the emphasis here is reasonable. So reasonable compensation is the value that would ordinarily be paid for like services by like enterprises under the circumstances. So let's translate that in English in a form of a couple of questions here. So how much compensation would be paid for this same position held by a non-owner in an arm's length employment relationship at a similar company? If you had to go out in your community and hire someone to replace yourself and perform the same services and tasks that you currently perform, what would you have to pay them? You were to close your business and go across town and work for a competitor and performing the same services and tasks that you currently perform, it's just that you're doing it for your competitor, what would that pay look like? What is the fair market value for those same services? So if you notice from all these three questions, it is all about the market value of the services you perform. Assuming you work for another company as a senior plumber and managing other people and making decisions, how much would you pay yourself? So keep compensation in line with similar businesses or paying for a similar job, and make sure you have evidence to support why you're paying yourself that amount of wages, just in case you're questioned later on or you get audited. So let's differentiate wages and distribution, because this is part of the concept here is really part of that reasonable compensation. So wages is subject to payroll taxes, while distribution is non-taxable except if there is excess distribution, and in that case, it will be subject to capital gain tax. So generally speaking, shareholder thinks that they can save money by taking higher distribution and pay as low as possible on wages to avoid additional payroll tax. However, that is lost revenue for the IRS. So to prevent S corporations and their shareholders from avoiding payroll taxes, IRS requires S corporations to pay shareholders who provide substantial services reasonable compensation. So if your company selected for an IRS examination and they found that the shareholders are not paid reasonable compensation, they can reclassify the distributions paid, reclassify that as wages, and assess payroll taxes. The IRS has the authority to do that under Section 7436 of the Internal Revenue Code. These are a few of the court cases on reasonable compensation, emphasizing that the IRS has their eyes on this. They are aware of taxpayers minimizing wages and maximizing distribution, so they are doing more audits of reasonable compensation. So let's move on to another way of taking money from the business, and that is distributions from the S corporation earnings. So if you're following the reasonable compensation on paying yourself wages, then the next way to take money out is through distribution. So as you've seen on the previous slides, distribution is generally non-taxable, of course, with exceptions. We can't really talk about distribution and its tax impact if we don't talk about and understand shareholder basis. What is basis? How do you track your basis in the business? For non-tax professional, it can get really confusing and complex. However, it's really important to understand the concept because as a business owner, it has tax implications on your individual income tax return. It can dictate if you can deduct your business losses or if you will be taxed on the distribution that you've taken from the business. So let me try to explain the concept of basis in simple terms. The basis functions similar to equity. Your equity beginning balance from year one is really your investment in the business and is showing on your balance sheet. So the liabilities and equities are the sources of funds to finance a business. You borrow money from third parties and then you invest your own money, your savings, to finance the business operation. You use these funds to buy assets so you can generate sales and, of course, with the objective of generating profit. Of course, you expect that money that you invested in the business, it will grow in the form of business profit. However, it's also possible that your investment will shrink with losses, especially on the first year or two. So your beginning basis will increase with the net profit and it will decrease with net losses. Other factors that reduce your equity is your distributions or draws. So say you have 10,000 of initial investment and for the year you generated 11,000 of net profit. So your basis here is total of 21,000. Let's assume that you have taken a 22,000 of distribution. So you have an over or excess distribution of 1,000 because your basis is 21 and you've taken 22. That 1,000 is subject to capital gain tax. So you probably ask, why am I being taxed on the excess distribution? So think about this. You will not be taxed on your initial investment of 10,000 because that's your money. You're just taking the money you invested in the business. So think of it like the money you put on your savings account. Once you withdraw the money, you will not be taxed. So how about the 11,000 profit? Remember that you get a K1 from the S corporation, and then that K1, for example, it's showing a net profit of 11,000. That will show as an income, additional income on your personal tax return, your 1040. So when you take that money from the business through distribution, you will not be taxed again because it's already been taxed previously. The excess distribution is not yet taxed. That is why it's subject to capital gain tax. So let me go over this sample basis calculation. Again, I want to emphasize this is oversimplified. This is a very simple illustration and does not cover all the items that goes into the calculation of basis. You should consult your tax professional to explain in detail the other items affecting the calculation of your basis. Again, why do you need to understand this? Because it will help you understand if you can deduct your losses or if you will be taxed on the distribution that you've taken from the business. So let's look at a simple or oversimplified illustration here. So let's say you have an initial investment of 10,000, and in year one, you generated a profit of 60,000. So again, that 60,000 will be reported on the K1. You will receive the K1, and that K1 will be reported as additional income on your individual income tax return. So that will be taxed as ordinary income. Now you have a tax-exempt income, for example, like a PPP loan forgiven. So that gives you a total basis here of 75,000. So 10 plus 60 plus 5. Now you had a distribution of 5,000 and non-deductible expenses, which decrease your basis. So at the end of year one, you have a basis of 69,000. And that will be your beginning balance for the following year. Now you have an income on year two of 50,000. Again, that will be reported on your K1, and that will be taxed as ordinary income. Now your total basis here is 119,000. Assuming you took a distribution of 120,000. So your basis is 119, your distribution of 120. That means you have an excess distribution of 1,000. That 1,000 will be subject to capital gain tax. There's actually a separate form, Form 7203, that shows the details of your basis calculation, and that's included as part of your individual income tax return. So you might want to check that on your tax package. Another way to take money from the S corporation is borrowing money from the business. Keep in mind that you need to have a properly prepared and executed promissory note. So properly prepared means it should include normal lending terms like interest, terms, and amount of periodic payment. Properly executed means there is a payment being made on a periodic basis. Last one I want to point out here is reimbursement of expenses. So if you spend your own money on business-related items and you want to be reimbursed, be sure to provide the documentation to support the S corporation disbursement to you. So let me recap ways to take money out of the S corporation the right way. First one is wages. Of course, you want to make sure that you're paying yourself reasonable compensation. Distribution. Keep in mind that non-taxable distribution is limited to basis. If there's any excess distribution, it will be subject to additional tax, capital gain tax. So it's important to understand your basis and track your basis to know if you will be taxed on any excess distribution. You can take money or borrow money from the business for as long as you have properly prepared and fully executed promissory note. And then lastly, if you want to reimburse yourself for the expenses that you paid out of your personal account, then you have to make sure that you have all the supporting documents. So again, this is Christy Fontanilla. Thank you for watching, and I'll see you next time.